So we will start with our last part of this chapter, which is money market instruments. Okay, this is the easiest part in your security valuation chapter. Okay, you just need to understand the math behind it. Okay, just simple calculations. If you use logic, you will get the answer automatically. Okay, just calculations. So what it is, what are money market instruments? Okay, there are two type of markets. Okay, one is capital market, another one is your money market. Capital market is for the market of securities which is traded for more than 1 year, which is for long term, and money market is your market where only short term bonds are traded. Okay, short term securities are traded. Okay, so how short it is? It can be 1 day to 1 year. Okay, it can be 1 day to 1 year. Okay, so what are the examples of money market instruments? It is your commercial papers, certificate of deposits, treasury bills. What are commercial papers? Commercial, this is only for knowledge purpose. Okay, commercial papers are those which are issued by big companies. Okay, like Reliance, Tata, Adani, like big companies, and it is bought by HNIs, mutual funds. Okay, so what happens? Commercial paper is your type of debt security only, borrowings only, but there is no charge on asset. Okay, there is no collateral. Next, certificate of deposit. Certificate of deposit is raised by banks. Okay, raised by banks, and it is bought by normal people. Okay, treasury bills are issued by the government of India. Okay, it is issued by whom? RBI. Okay, it is issued by RBI, but who gets the money? The government of India gets the money. Okay, it is it is issued at discount and redeemed at face value. These money market instruments, they are not given interest generally. Okay, they are issued at discount and redeemed at face value. Okay, so some calculations that are needed to be done for exam purpose. You know why is this is it issued at discount and redeemed at face value? Because it is taken only for a short term. Okay, so when will they pay interest? Okay, so that's why what they do, they just issue it at discount, and at the end of the time they just pay the face value. Okay, this is the basic logic behind it. Okay, so some calculations that are needed to be done for exam purpose. Okay, for exam purpose we need to only focus on this. What it is? Nominal interest or yield, or nominal interest, nominal yield, or bond equivalent yield. It all means the same. What it means is that the nominal interest rate paid annually, okay, paid by the company on issue price of the thing. Okay, on issue price, how much is the nominal interest gained by the company? Okay, so what they are trying to do, let's take an example that it is issued for a discount of 97. Okay, its face value is 100. Okay, so how much cost did the company incur? Okay, we won't take 100 down. Okay, because the company only got 97 rupees. So divided by 97, how much did he get? 3.09% was this interest rate. Okay, it got only how much? 97 rupees. No, that's why. So what is the formula here? As I told you, 100 minus 97, that is your face value minus your issue price, divided by your issue price into what we need to calculate. This is only for how much? This is only for a certain period. Okay, so for annualized, how much will it be? Whenever we calculate yield, it will be annualized only, not for a certain period. Okay, so we need to calculate annualized yield. So this is for, let's suppose it is for 3 months. So how much will it be for a year? Okay, how much will it be for a year? A year is 12 months. Okay, so 12 months divided by 3. Okay, 3. So for a year it is 12.37%. Okay, what was the interest rate? It is 12.37%. Okay, basic only, just apply logic. Next, now what happens in certain question, they ask you reverse calculation. What happens? They ask you p value, they give you f, they give you y, but p is missing. So how will we calculate? Okay, for that a formula is given here. You can use this also. Okay, but here shortcut is given. So what will be its formula? Let's suppose yield is given as 12%. Okay, 12% is the yield given. Okay, we'll calculate it for one time only, for the period. Okay, for the period we'll calculate. So how we'll do for 3 months, right? For 3, okay, for 3 months divide by 12. Okay, it comes to 3%. Okay, so we'll take it in decimals, plus 1. Okay, so now what will happen? The face value, it is going to get 3 months ahead, no? So we need to PV it to the present value. Issue price is present value. So what we do? We do PV of it one time. Okay, into how much is my face value? 100. So this answer will be getting. Okay, very simple. Okay, here I took yield as 12%. Okay, if we had have taken the yield of this one, we would have got the same answer as 100 or 97. Okay, next, discount yield. What is discount yield? Discount yield is how much yield are you getting, okay, on the face value. Okay, how much yield are you getting on the face value? So what do we do? F minus P divided by F. Okay, we take the total value. That's the only difference here. Rest all it is same. Discount yield means what? We have to take face value in denominator. Okay, next, effective annual return or interest or EAR. So what they are asking is effective annual return or interest. So effective annual interest, don't you think we did the same thing here? Nominal interest or yield or bond equivalent yield, we did the same thing, right? We did the same thing. We here also we took for 12 months only. So what is different here? What is different in effective annual interest? The difference lies in the type of interest. Here it is compound interest, and here it is just simple interest. Okay, so what this assumes is, if we put on for 3 months we took the security, right? So for every time we reinvest the same amount, okay, plus interest component. So how much will we get? This is compound interest. Okay, so what is the effective annual return or interest? So that's what they are asking. So how we will do? First we take the nominal yield. Okay, nominal yield, that is your bond equivalent yield we take. Okay, how much is it? We assume it as 12%. Okay, now what is the period? Now we'll take in days. Okay, let's suppose it was for 91 days. Okay, and what was my total days? It is 365. Okay, this was the for one period. Okay, for one period this was my interest rate. Okay, now this was my one period interest rate. How much will it be for 1 year? Okay, so we'll take it in decimals. Okay, plus 1. Okay, now this is the value I'm getting for, we need to what? We need then what we'll do? We'll take it for full year. Okay, full year, how much is it? Divide by the total. See, for 1 year, for 365, for 91 days, one amount is there. Okay, we are just doing cross multiplication. Okay, let me explain it to you better. See, for 1 year, for one period it is 2.99. Okay, for 3 months it is 2.99. Okay, for 90 days it is 2.99. So how much will it be for 365 days? We are just doing cross multiplication, but in power we are taking. Okay, in power we are taking. Okay, so it will be how much? 365 divided by 90, right? So we just have to remove the dirty power. Okay, so for dirty power what we do? 12 times root button and 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Okay, now we do minus 1 into our power into 365 divided by 90. Okay, now we do plus 1. Now multiply equal to 12 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Okay, now minus 1 into 100. I am getting something different. Okay, I might have made some mistake here. Okay, my annualized yield is, I made some mistake in question. We'll solve it better. Okay, cost of funds calculated in case of commercial paper only. Okay, what is commercial paper? It is a debt. It is a debt security only. Okay, but there is no collateral. So here they are given formula. Forget formula. Okay, so what they are asking is cost of funds. What is the cost of fund for the company? Okay, what will be its cost? Interest is its major cost. Okay, interest will be its major cost. Rest all what will be the cost? Flotation cost, issue cost, right? It is also cost. So issue cost is an expense. So expense gets tax benefit, right? Also interest also gets tax benefit. So we'll take it net of tax. Okay, divided by your issue price. What is the issue price? What is the net amount received by the company? That only it will take. No, not the actual amount. Net amount what it is, we'll see. Okay, so the amount it got, okay, issue price minus its issue expenses, right? Issue expense is its expense, so it is gone from its pocket. Okay, also it will be received in a bank, right? But in bank there has to be a minimum balance maintained, so we have to keep it in bank only. Okay, so that's the logic behind it. We'll see it in question, very easy. Okay, next, repo transaction in money market. Okay, this one is important. Okay, just listen to me. What is a repo transaction? Okay, repo rate, you have heard it, right? Repo rate, you have learned the definition in earlier standards. Okay, in earlier period you have learned the definition of it. What is the definition of a repo rate? A repo rate is a rate in which the commercial bank borrows from the central bank, that is the RBI. Okay, it is a rate at which the commercial bank borrows from the Reserve Bank of India. So what see, now what is happening, that a bank is borrowing from central bank, that is the RBI. Okay, Reserve Bank of India. So for getting any money, for borrowing any money, what needs to be kept? Security needs to be kept. Okay, collateral needs to be given, charge and asset has to be created. Okay, so now what happens is that what security will it give? The bank. Okay, the bank, what security will it give? It is decided by RBI, central bank. Central bank says, you see what happened, you buy my Government of India bonds, okay, and keep it as a security here. Okay, so that's what RBI says. So now what happened, RBI got money from there also. What? Government of India bond, and from here also as a security it is getting. Okay, so double dhamaka. Okay, so that rate is known as repo rate. Okay, so after that what will happen when the company will, when the bank will repay that amount, it will get the securities back. Okay, so it is repurchase agreement. Okay, now you say when you go to keep, I'm teaching this very well. Okay, see, when you want how much, 1 lakh, you want 1 lakh rupees. Okay, 1 lakh rupees you want. This is a man. Okay, his name is what, Ram. He wants 1 lakh rupees. So he goes to the bank. He goes to the bank and asks for money. Bank, give me 1 lakh rupees. Give me 1 lakh rupees. Give me 1 lakh rupees. So what is bank saying? Bank saying that I will not give you in fukat. Okay, for that you need to keep some security with me. Okay, what is it? We'll call, in general terms we call it charge on asset or pledging or collateral. Okay, collateral. You have to keep some collateral security. So what he has some jewelry with him. Okay, he has some jewelry with him. So he is keeping the jewelry with him. Okay, so how much jewelry you need to keep? That bank will decide. Okay, so will it be any amount lesser than 1 lakh? No, never. They play it very safe. They take 2 lakh worth of jewelry, okay, for 1 lakh, okay, to cover the interest expense. Okay, so after you will take for a longer period, right? So to cover that interest part they take more. Okay, so that safe they play. Okay, so if he doesn't pay the amount, this whole amount will be liquidated. Okay, so bank is what? Bank is taking some extra money only, but this is for long term. What if he is asking for short term? Let's say for 3 months. What will happen? Then this amount will be less. So let's say it is 1,25,000, right? So this is the same logic being applied in our concept here. Repo transaction is, in this transaction, I'm not going to read this. So what happens? He will take what? Securities. Okay, if he is taking more amount, he will give me only less amount. Okay, he needs more security, the bank needs more security, so that he can give some amount. Okay, so more amount he is taking. So this is the margin that is taking. How much margin? 25,000 margin is taking. Okay, so if I put it into terms, it is how much? 20%, right? 20% or 25%? 25%. Okay, so here in repo transaction it is very less. Okay, for very less time it is taking, so that's why margin will also be less. Okay, so this is what, this is my girvi amount, right? This is my security collateral. Okay, government of bond, okay, sales amount minus my initial margin. Okay, how much? It will be very less. Okay, let's say he takes 2%, 5%, whatever in given in question. Okay, so government of bond, now when he repays, what will he do? He will add repo interest to it, right? He will take this amount, he will add repo interest, that is the interest, that is how many days he has taken divided by 365. This is basic calculation. Okay, just interest calculation, P into R into T. Okay, simple interest. Okay, that we need to calculate and we'll pay it back. Okay, now there are some concepts here, okay, that we need to, some terms that we need to understand. Okay, now this government of India bond sales amount. Okay, now what happens? This he will not give. See, in bond what happens? Bond is for longer term. Okay, bond is for long term, right? Bond is for long term. Okay, so for many years they have given, and let's suppose its interest rate is 5.65%, right? So what happens is the bank is going, interest is paid every year on 31st March. Okay, so bank is going to take loan from RBI when? On January. Okay, in January. So till April to January, from April to January, there will be accrued interest, right? There will be accrued interest. So this accrued interest will also form. See, now we are keeping the security with the where? RBI. Okay, let's suppose bank. RBI is my bank. Okay, I am keeping my security in my bank. Now let's suppose I am taking loan for how many months? 4 months. Okay, 4 months. Now what happened? January, February, March. He will get interest. No, he will get interest. Whatever interest he gets, he will receive it. I will not receive. He will receive. So what happens? This accrued interest will form part of. So he will get interest, right? He will get interest. So what I will do? I will not take the. I will include the accrued interest part also. When doing this transaction, I will include accrued interest part, so that whenever he is getting, he will minus from it. Okay, so that's why this is known as, if we add to your value of bond plus your accrued interest, it is equal to dirty price. Okay, this is the term that they give. The value, which is, it is known as clean price. Okay, so clean price plus accrued interest is equal to dirty price. They have just given term for it. Okay, that's it. Okay, you understand this concept? Clean price plus accrued interest is equal to dirty price. Okay, now there are some notes given here. Okay, number of GOI bonds is equal to total face value of GOI bond divided by face value of single bond. This is very basic. Okay, face value of single bond is not, if it is not given in question, we will assume it as 100. Okay, dirty price is equal to clean price plus accrued interest of bond. Okay, clean price is the price of government bond at the time when the last interest was paid. Okay, it actual value of it. Okay, accrued interest on GOI bond is equal to face value of single bond into interest coupon into accrued interest divided by simple P into R into T. Okay, normal interest, your basic mathematics. Okay, so this was the total concept of it. I hope you understood. Okay, I've explained it to you very well. Like in regular patches only, they will explain it like this. Okay, I've explained it to you in my YouTube video only. Okay, so we will start with questions. See, there are some basic sums here. Okay, question number 57, you just have to put in formula. It is easy and logical. Okay, so just put formula in it. What is the formula? P is equal to F upon 1 plus Y into N upon 365. Okay, whatever the case may be. So 58 is also easy, you can do it by yourself. 59 is also easy. You can, if you just look at the solution, you will get the answer. If you just look at the concept book and apply the formula, you will get it very much straightforward. Okay, next, this 60th question we'll do. Okay, it is a good question, we will do it. We will solve it in class. Now, we'll read it. A money market instrument with face value of rupees 100. Okay, face value is given, discount yield is given 6%, maturity period is 45 days. Okay, we need to calculate current price of the instrument. Okay, very much easy. They have given yield percentage, so we will do what um, yield percentage they have given, right? 6% is for the year, we assume. Okay, 6% is for the year. 6 into how much? 6% is, it's for the year. Okay, so divide by 360. Here they have given, assume it as 360, right? Can you see? No, what? Wait a second now. Now you can see. Here in question they have told us assume 360 days a year. Okay, so for one day it is 0.016%. Okay, into how many days? For 45 days I need. So 0.74% is the interest rate. Okay, now divide by 100 plus 1. So for now we need to do PV of it. Okay, divide by 1 into how much is my face value? It is 100. Okay, I am getting 99.25. What I did, I applied this formula. See, I applied this formula. They have given price of it. Okay, they wanted me to find price of it. They have given yield. Okay, so I just use this formula to find it out. Okay, so what I'm getting? 99.25. 99.25. Next, what they are asking is bond equivalent yield. Okay, bond equivalent yield means what? F minus P divided by P. This is my P, right? So they are asking bond equivalent yield. How much is it? Okay, so what we need to do? Minus 100 divided by 99.25. Okay, into 100. So 0.75 is my period's interest. Okay, now we need annualized. Okay, bond yield is bond equivalent yield. We always, for percentage, we need to do it for year. Okay, into, for how many days was it? For 45 days, right? So how many days is it for? 360. 360 divided by 45, it is 6.00. I took actual figure, right? So that's what I am getting. If I took only this thing, only 99.25, I'll get 0.25 minus 100. Okay, divided by 9. So I'm getting 6.0. Only for why I got different answer is because I took the whole figure in the calculator. If I took only 99.25, I'll get this. Okay. Now they have asked effective annual return. Okay, effective annual return. So that's why I took this question. So here we only calculated simple interest. So here effective annual return, we need to take total interest. Okay, compound interest. So how we'll do, I'll write it in the question. Okay, question number what? Question number 60. Question number 60, part number 3. Okay, effective annual return or effective annual interest. So how we'll calculate? See, what was my yield? My yield was 6%, right? We first need to put formula here. In formula we'll put calculation, we can do it in calculator. Okay, for formula 1 into yield. What is my yield? My yield is 0.0645, right? 0.66045 into how many days? It is for full year, right? We need to take for 1 divided by how much? 360 into 45, right? Now up what figure will come? It will be my face. It will be just 1. We need what? We need only we need only interest rate, right? We just put in the formula. Okay, sorry, 1 plus 0.06045 into 45 divided by 360 raised to 360 by 45 minus 1. Okay, we can calculate in calculator. Okay, so how we'll do 0.06045 into 45 divided by 360. This is what? This is for the specific period. Okay, plus 1. Okay, now what we need to do? We got this 1.00755625. We got this amount. Okay, now we what need to do? We need to take it for 1 year. Okay, if it is for 45 days, okay, how much will it be for 1 year? We need to take. It is dirty power, right? Now we need to do the calculator trick of 12 times root 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 minus 1, okay, into how much? 360 divided by 45, okay, plus 1 equals 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, okay, minus 1. We are getting 6.20. Okay, 6.207 or 21%. Okay, 207%. Okay, or 6.21, whatever. Okay, this is my answer. We took compound interest into play. Okay, the concept is important. Okay, this you can do it anyhow. Okay, this is just formula. Just put formula and you will get the answer. Okay, just logical the formula is. Next question number 61. It is a good question. Okay, so what is it? Wonderland Limited has excess cash of 20 lakhs. Okay, which it wants to invest in short-term marketable securities. Okay, it has 20 lakhs. It needs to invest in marketable securities. Expenses related to the investment is 50,000. Okay, I'll solve this question. Okay, I'll solve this question. Question number 61. So the securities invested will have yield of 9%. Okay, 9% is my annual yield. So I'll write it here. Okay, yield or Y is equal to 9%. The company seeks your advice as to the period of investment so as to earn a pre-tax income of 5%. So what it needs? It needs an income of 5%. So what is my investment amount? 20 lakhs into how much? 5%, right? So what? How much is it? 1 lakh, right? Rupees 1 lakh. Rupees 1 lakh. I need return from it. So 1 lakh if I need, so how much will be the period for it? Okay, 20 lakh into, I'll take full amount only, 20 lakh into 9%, that is P into R into T into period. Okay, that is N divided by how much? We'll take 12. Okay, in absence of days we will take only month. Okay, it is easier. But you know what is equal to how much? 1 lakh. Okay, is equal to 1 lakh. But you know what? This 9% is for the year, right? And this 9% is for the year. Why have we taken n upon 12, right? So here it will only come 12, right? 12 upon 12, right? So here it will come 12 upon 12. Okay, so if you solve, how much we are getting? 20 lakh into 9%. Okay, 1,80,000 we are getting per year. So if we calculate for 1 lakh, so how much will we get into divide by 12 into 1 lakh divided by 15,000. We are getting 6.67. But is it right? No. Because expenses related to investment will be 50,000. Okay, the CA's fees, okay, and the securities fees, something, it is comes to 50,000. So what we do, we add 50,000 here. So what is my effective rate? What is my effective how much do I need to earn to get 1 lakh? It is 1,50,000. Okay, so that my expenses are mitigated. So 1,50,000 I need to earn. So now if we do 1,80,000 here, it is coming, okay, into n by 12 is equal to 1,50,000. So how many days will it take? If you calculate, we'll get how much? 1,50,000 into 12 divided by 1,80,000. Right? If you solve it, you get n as 10 months. Okay, so this was the catch. This 50,000 was the catch. Okay, if you look at here, you will be very much confused. Okay, so what they are asking, the minimum period for the company to break even its investment expenditure over time value of money. Okay, now it's asking break even. Break even, how will we do it? So for 1,50,000, it was 10 months. How much will it be for 50,000? We just have to do cross multiplication. Okay, so it will come to 3.33 months. Right? Or else in formula, if you want to show it, how will show? Will show break even is equal to 1 lakh 80,000 divided by 15,000. We'll show it as 20 lakhs into 9%. Okay, 20 lakhs into 9% divided by, here we'll do this one is logical for me. We'll check the solution for it for the formula. See, what they have said is 20 lakhs into 9% into p by 12 minus 50,000 is equal to 0. So we get p is equal to 3.3. This one line formula we need to write. Okay, that you figure it out. Okay, so next we'll move to question number 62. Okay, question number 62. What is this? AXY Limited is able to issue commercial paper of 50 lakhs every 4 months at a yield rate of 12.5%. Okay, commercial paper. Okay, I explained you earlier. Commercial paper is a debt security which takes no collateral. Okay, 50 lakh for every 4 months at a yield rate of 12.5%. The cost of placement of commercial paper issue is 2,500 per issue. Okay, AXY is required to maintain a credit line of 1,50,000 in the bank balance. That is a minimum balance of 1,50,000 has to be kept in bank. The applicable rate of income is 30%. Okay, what is the cost of funds after taxes? Okay, they are asking cost of funds. We need to put the formula only. For commercial paper issue, the maturity of commercial paper is 4 months. Okay, we just put formula here. What is the formula? So they are just asking what cost of funds. Question number 62. Cost of funds they are asking is equal to what? cost of funds is equal to how much did we borrow? 50 lakh, right? Now we will calculate some interest. Okay, interest I part will calculate. How much is it? 50 lakh into 12.5%. How much is it coming? It is coming to 6,25,000. Okay, per year. Okay. They have given for 4 months we need to take. Okay, so this is for 1 year. For 4 months it will be how much? 625 divided by 12 into 4. It is 208,333, right? For 4 months. Next, issue expense. It is for 4 months. Sorry, 2,500 they have given in question per issue. Okay, this is per period, this is per issue. Okay, and minimum balance is 1,50,000. Okay, tax is 30%. Okay, now we put the formula. Okay, cost of funds is equal to interest expense, that is your 208,333. Okay, plus your issue expense 2,500. Now this is an expense, this is an expense, so we take net of tax. Okay, we have to pay less tax, divided by our net amount received by the company. How much is the net amount received by the company? We'll show it in working note. Working note, net amount received by company. By company, how much is it? The company is getting 50. Will it get 50 lakhs? Yes, 50 lakhs it wants, but issue price is also getting out of hand, right? Minus 2,500 minus what? Your minimum balance to be kept in the bank, right? So how much is the net amount we are having in hand? We are having 47,500. Okay, we'll just divide it with it. 1 minus t is 0.3, right? We'll just divide it with 47,500 into, this is for 1 period, right? For, we need to calculate it annually. Okay, so it is, have they given any time limit for it? No, right? There is no time limit. So we'll take 12 months. 12 divided by 4. Okay, so we'll get the answer. See, the main thing is about calculator only. This you just need for presentation. Okay, 208,333 plus 2,500 into 0.7 divided by so my annualized yield is how much? 9.13%. We'll cross verify with the question with the 9.15% they have taken. Okay, we have got 9.13 because we took the full amount. This is the rounding of error. Okay, so just this much rounding off is okay. Okay, we got the answer. Oh sorry, wait a second, we have made a mistake here. The interest expense is not 208. Okay, this is wrong. That was not this error. calculation error or rounding off error. We have made a big blunder. See, issue price was 50. Okay, so we need to what? We need to PV it. Okay, so at present how much we are getting, that we need to see. Okay, so they have given issue price. They have given issue price here. They have given issue price is able to issue 50 lakh. Okay, they have given here issue price, that is after 4 months they will get 50 lakhs, but at present how much they are getting, so that we need to find. So 0.125 into 4 by 12, okay, plus 1 divided by into 50 lakhs. So 48 lakhs we are getting. This is my net amount I am getting in my bank. Okay, this is my net amount I am getting in my bank, minus 2500 minus 1,50,000. Okay, this is my actual net amount received by the company. Okay, so my interest expense is how much? 2 lakh. 48 lakh I was getting, so I will have to give 50 lakhs. So 2 lakh is my extra amount. So 2 lakh plus 2500 into 0.7 divided by MRC into 12 by 4. So we are getting 9.15%. Okay. So don't make this mistake. If they have given the price of 50 lakh, okay, so 50 lakh is after 4 months they will be giving. So at present how much will they get? They will issue at discount. Okay, commercial paper are issued at discount. So at discount how much will get? 48 lakhs. Okay, so 2 lakh is my interest. The whole question will be wrong. My goodness. So we'll move on to the next question. So that's why without looking at the solution, try to solve it in the calculator first, so that you can get your mistakes caught early on. Okay, if you want, do writing practice. Just scribble, but do writing practice. Okay, next, our last question for the day, it is based on repo. Okay, Bank A enters into a repo rate for 14 days with Bank B. We will assume this Bank B as our RBI. Okay, this Bank B is my central bank. Okay, RBI is also a bank. Okay, this is the Central Bank of India. So Bank A enters, this is my commercial bank, it is entering into the repo of 14 days with the RBI of they have to give collateral, right? That is 10% Government of India bonds 2028 at the rate 5.65%. Okay, this is the annual rate for bond. Okay, how much is it for? 8 crores. Okay, 8 crore. Assuming clean price. Okay, clean price, they have already given it. The price does not have accrued interest. It is at 99.42 and initial margin as 2%. Okay, and days of accrued interest is 262. You are required to determine dirty price and payment at maturity. So what is my dirty price? My clean price is how much? 99.42. So my dirty price will be how much? I am assuming my face value is 100. Okay, so 100 into how much is my rate of interest? It is 5.65%. So 5.65 is my interest into how many days has been accrued for 262. 262 divided by how much? 360 days. Okay. So 4.11 plus how much? 99.42. wait a second, sorry, this repo transaction is for 5.65, but government of India bond is 10%. Okay, so 10 into, so 10 will be my interest into how much, for 262 days divided by 360 into plus what, 99.42. See, one thing you can keep in mind, that your government of India bond will not be of less value. Okay, it is of more value only, 10%, 9%, because in FD only you will get 7%. So why will one take for 5.65%? Okay, so use that logic. So 106.70 is my dirty price. Okay, next. Now we have to do it in two legs. Okay, what they are asking is repayment at maturity. Now we'll use logic. So how much is the total bonds? It is 8 crore divided by how much, 100 is my face value, so 8 lakh bond is there. So when we give the security to the bank, to the central bank, so you will get the accrued interest benefit also. So what we do, we take dirty price, okay, into 106.7. okay, this is the total they are getting. But will he give me total this much amount of loan or what? No, he will take initial margin. How much is it? 2%. Okay, so this is the proceeds we got. Okay, this much we will get our interest. This much we will get what? This much loan we can get. Okay, so when we repay it, what we do? We do into, we'll have to add interest rate also, repo interest rate. So how much is it? 5.65%. okay, 5.65% for how many days? It's for 14 days. okay, for 360 days it is 1.13. so for 14 days how much is it? 18103 M plus MRC. We are getting how much? 838 36603 86604. okay, so that's it. Okay, this question was so easy. Do it logically, you will get the answer. Okay, so that's it for this lecture. Tata, bye bye.